You found the perfect house. You make an offer, and the seller picks someone else instantly. Why? Because you didn't have a mortgage pre-approval, and in a hot market, that one missing piece quietly kills your dream before it starts. Most first-time buyers learn this too late, and it stings. Pre-approval isn't paperwork you grab at the end. It's the very first step, before you tour a single home, before you fall in love with anything you can't actually afford. So what is a mortgage pre-approval really? It's a lender's conditional commitment to loan you up to a specific amount based on a real review of your finances. It tells you your budget and tells sellers you're serious. First, clear up a common confusion. Pre-qualification and pre-approval sound like twins. They're not. One is a guess, the other is checked. Mixing them up can wreck your offer when it matters most, so let's separate them clearly. Pre-qualification is a quick, informal estimate. You self-report your income and debts. The lender takes your word. Nothing gets verified. It's useful for a rough idea, but it's weak. Sellers know it carries almost no real weight. Pre-approval is the serious version. The lender verifies your documents and pulls your credit. They actually confirm what you told them. The strongest form of verified or underwritten pre-approval is gold in a competitive bidding war. So what does a lender actually dig into? 5 big things. Your credit score, your income, your employment, your assets, and your debts. Each one tells them whether lending to you is safe or a gamble they'll regret. Credit score comes first. It's the number that signals how reliably you pay people back. A higher score unlocks better interest rates, which can save you tens of thousands over the life of your loan. Check yours early. Next, income and employment. Expect to hand over pay stubs, W-2s, and often tax returns. The lender wants proof your money is real and steady. Stable documented income is one of the strongest cards you can play. Then assets. They'll review your bank statements to see your savings, your down payment, and your cushion. They want to know you can cover the upfront cost and still survive a rainy month without instantly missing a payment. Now the number that quietly decides your fate, your debt-to-income ratio, or DTI. It's your total monthly debt payments divided by your gross monthly income. Lenders study this harder than almost anything else on your file. The rule of thumb is simple. Many loan programs want your DTI under about 43%. Go higher, and approval gets shaky. The fix is easy to say, harder to do: lower your debt or raise your income. Picture it plainly. If you earn $5,000 a month and pay $2,000 toward debts, that's a 40% DTI. That's just an example, but it shows how fast car loans and credit cards eat your power. Survive the review, and you get the prize, a pre-approval letter. It states your maximum loan amount, your estimated interest rate, and your loan type. This single page transforms you from a window shopper into a real, credible buyer. But that letter has a clock on it. It's usually valid for around 60 to 90 days. After that, you re-verify your documents because lenders want a fresh picture. Treat it as a deadline, not a forever pass. And a quiet myth needs busting. A pre-approval is not your final loan approval. It's a strong conditional yes. The deal still has to clear a few more gates before the money actually lands in escrow. Now, the fear that stops people. Yes, pre-approval triggers a hard credit inquiry, and yes, that causes a small temporary dip in your score. But it's tiny, and there's a part nobody tells you about it. Rate shopping is protected. If you apply to several mortgage lenders inside a short window, roughly 14 to 45 days, the credit bureaus count it as a single inquiry, so shopping around barely dents your score at all. Which means you should absolutely shop multiple lenders, compare their rates, their fees, and their loan terms. A fraction of a percent on a 30-year mortgage can mean thousands of dollars staying in your pocket instead of theirs. Now, the danger zone, the part where smart people blow it. Once you're pre-approved, your financial behavior is being watched right up until closing. One careless move can quietly destroy the approval you worked so hard to earn. Rule 1. Do not open new credit. That shiny store card or new credit line changes your DTI and your score overnight. Lenders recheck before closing, and a surprise account can turn your yes into a flat no. Rule 2. Do not make big purchases. The classic killer is buying a car. A new monthly payment wrecks your debt-to-income ratio at the worst possible moment. Whatever you want, wait until after you have the keys. Rule 3. Do not change jobs or move big money. Switching employers spooks lenders, and large unexplained deposits raise red flags they must investigate. Keep your income steady and your bank account boring until the deal is fully done. Think this is overcaution? It isn't. Loan officers have watched buyers lose their dream home days before closing because they financed furniture or a truck. The deal collapsed at the finish line over a purchase that could have waited. That's why discipline here pays off enormously. The few weeks between pre-approval and closing are the highest stakes financial stretch of the whole process. Boring is beautiful. Doing nothing risky is actually the most powerful move you can make. And remember, the home itself still has to qualify. It needs an appraisal to confirm it's worth the price, plus final underwriting. The property and your updated documents both have to check out before everything is truly approved. So how do you win at this? Preparation. The buyers who sail through pre-approval did the quiet work first. Let's walk through exactly what to do this week before you ever talk to a single lender. First, check your credit early and check it carefully. Pull your reports and hunt for errors. Mistakes are shockingly common, and a single wrong late payment can drag your score down and cost you a better rate. Second, pay down debt to lower your DTI. Attack credit cards and any loan you can knock out. Every payment you erase frees up borrowing power and pushes that all-important ratio into the safe zone lenders love. Third, save aggressively for your down payment and closing costs. Closing costs catch people off guard, they're real, and they add up. The bigger your cushion, the stronger your application, and the calmer you'll feel signing. Fourth, keep your documents ready and organized. Pay stubs, tax returns, W-2s, bank statements, all in one folder. When the lender asks, you respond in minutes, not days, and a fast, prepared buyer looks like a safe bet. Fifth, and this is the big one, get pre-approved before you house hunt. Not during, not after, before. House hunting without it is like shopping with no idea what's in your wallet, a recipe for heartbreak. You're allowed to relax a little here. This process feels intimidating, but millions of ordinary people do it every single year. You don't need to be rich or perfect, you just need to be prepared and disciplined. Every step you take, checking credit, lowering debt, saving, organizing, makes you stronger and the whole thing less scary. You're not gambling, you're building a case that proves you're ready to own a home. That's real power. Let's lock it in. Pre-approval is step 1, a verified, conditional yes that sets your budget and proves you're serious. It beats pre-qualification because the lender actually checks your credit, income, assets, and debts before committing. Remember the levers. Watch your DTI closely and keep it under about 43%. Shop several lenders inside the rate shopping window so it counts as one single inquiry, and guard that pre-approval letter like treasure right up until you close. And never forget the golden rule of the danger zone. After pre-approval, no new credit, no big purchases, no job changes, no moving big money. Stay boring, stay steady, and let the deal cross the finish line. Do this right and you walk into home buying with confidence instead of fear. You'll know your number, sellers will take you seriously, and you'll dodge the silent mistakes that sink so many hopeful first-time buyers. Be honest with me down below. What's the one part of getting a mortgage that scares you the most? Whatever it is, type it in the comments and I'll do my best to tackle it. And if this made pre-approval finally click, send it to a future homeowner who needs to hear it. Drop a like and subscribe so you're ready for the next step.